17 days. That's all we've got before the Fed flips the switch and cuts rates. So in this video, I'm gonna go over what happens when they do. And I'm not just talking about mortgage rates. Yeah, I mean, we're gonna talk about that too, but this ripples everywhere. Stocks, gold, silver, Bitcoin, bonds, the stuff you buy on credit, and yes, inflation sneaks into the mix. So circle September 17th on your calendar. That's the next big Fed meeting. And right now, according to the CME Fed Watch tool, as of August 26th, there's an 88.3% chance the Federal Reserve will cut interest rates by a quarter point at that meeting. And that number, it's been bouncing around all over the place this past month, from 59% to basically a sure thing at 100%. And then it settled into the high 80s right after Powell's Jackson Hole speech last week. But here's the thing, even if they skip September, the Fed meets again in October, and the writing's already on the wall. They're going to cut. The only question is when. Check this out. This is what's really important. When the S&P 500 is within 2% of an all-time high and the Fed cuts rates, historical data since 1980 shows that the index has risen 100% of the time over the following 12 months, with an average return of 13.9%. On average, 1 month after the interest rate cuts, the stock market doesn't do much, on average about 0.1%. So it's pretty flat. Over the next 3 months, on average, the stock market goes up about 2.3%. Over the next 6 months, on average, the stock market goes up by 3.4%. And over the next 12 months, on average, the stock market goes up 13.9%. But I want to point this out to you right here. Look at what happens in that subset 12 months right there, 12 months out. In that subset, the market has gone up every time. Every time. And here's why I'm bringing this up. If you're sitting on the sidelines waiting for some massive stock market crash so you can swoop in and grab some great deals, the clock, it's not on your side. The longer you wait, the worse the odds are going to get for you. Now, if you're dead set on playing the buy the dip game, history does say that your best shot is likely the day after the rate cut. Because within a month of the Fed cutting, the market still goes up about 50% of the time. So yeah, waiting could work, but the window's tighter than most people think. And after 3 months, the stock market goes higher 77.3% of the time. And again, at that ending subset, the stock market has gone higher 100% of the time after 1 year, okay? I mean, sure, maybe this time will be different. Maybe 12 months after the Fed cuts, the market finally tanks. Could happen. But if you're asking me, I doubt it. Why? Well, because we're printing money like it's an Olympic sport on a scale we've never seen before. We're living through the great melt-up right now. And this great melt-up that you hear everyone talking about, it's when prices stop climbing like a staircase and start blasting off like a rocket. And I'm talking about stocks, metals, crypto, even real estate. Everything gets sucked higher, not because the fundamentals are amazing, but because cheap money is flooding the system and people are chasing returns wherever they can find them. And just look at the clues. The second Powell even hinted at rate cuts in Jackson Hole, gold spiked, silver shot up back over $39 an ounce, and Bitcoin with the altcoins all went on a tear. That's not random. That's inflation at work. Rate cuts pump money into the system, and money has to land somewhere. It lands in prices, whether it's gold, silver, Bitcoin, real estate, or the stock market itself. And one more thing worth pointing out, rate cuts don't just goose asset prices. They also drag down a country's currency. Case in point, as soon as the odds of a cut jumped on Friday, the dollar slipped. And when the dollar stumbles, commodities usually sprint higher. And gold's the obvious poster child here, but it's not the only one. Think of it this way, a weaker dollar doesn't just make stuff more expensive. It shoves money into hard assets that don't shrink when the dollar does. Take a look at gold's chart over the last 10 years, and you'd see the same thing over the last 30. On the surface, it looks like gold's been blasting higher. But that's not really what's happening. Gold hasn't changed, it's the dollar shrinking. And now, with another round of easy money policy on deck, the dollar's about to bleed even more purchasing power, which means one thing. Prices on financial assets, gold, stocks, real estate, crypto, are just going to keep climbing. Here, let's look at this chart. Look at the S&P 500 over the last 30 years. It's not a mystery. Easy money and inflation have been jet fuel for prices, and financial assets are the biggest beneficiaries. In the playbook, it's always the same. Rate cuts come first, then the quantitative easing. So together, what they call this is easy monetary policy. The translation here is the dollar gets watered down and prices across the board inflate. And if you caught the Fed at Jackson Hole last week, you saw it plain as day in their policy language. They're warming up to cuts now, and the money printers won't be far behind. So I'm guessing 2026, which is actually what I've been predicting. I predicted that last year because here's what I saw, what I've been seeing. Wells Fargo economists expect quantitative tightening to end by late 2025, with the Fed balance sheet staying flat through mid-2026. Then, boom, they'll likely restart the money printers then. And this isn't just my opinion anymore. It's becoming mainstream Wall Street consensus. Now, regarding the bond markets, in anticipation of the Fed rate cuts, interest rates on bonds started to fall. And this means that borrowing costs will finally begin to decline. Not rapidly, but it's all going to really depend on how quickly they cut rates for the rest of this year and into next. After Jackson Hole, the yield on the 3-month Treasury bill slipped because traders were already pricing in those rate cuts. And that's a huge win for the government, by the way. They lean hard on short-term borrowing. And if you've been paying attention, you know Trump's been hammering the Fed to cut rates so Uncle Sam's interest tab gets cheaper. Rate cuts help him make that case. But here's where it goes off the rails a little bit. I mean, just yesterday, Trump didn't stop at asking politely. He went nuclear. On August 25th, he posted on Truth Social that he was firing Fed Governor Lisa Cook, accusing her of mortgage fraud. And here's why this is significant. In the Fed's 112-year history, no president has ever tried to fire a Fed governor. Not once, until now. And Lisa Cook? Yeah, she's not rolling over. She shot back immediately and said, I will not resign. Now she's suing Trump to keep her seat, and her lawyers flat out calling the move illegal. So why does this matter for rate cuts, though? Well, simple. If Trump actually pulls this off, he flips control of the Fed board. That gives him the leverage to ram through whatever interest rate policy he wants. And let's be real, the timing, it isn't random. We're 17 days out from a huge rate cut decision, and Trump's literally trying to rewire the Fed to make sure it bends his way. The fight's already headed to the Supreme Court, which could rewrite the rulebook on monetary policy forever. But in the meantime, it ramps up the pressure on the Fed to cut in September, because they can see Trump isn't bluffing anymore. And the interest rate on a 10-year Treasury, that continues to go down. This 10-year is very important because this is where your mortgage interest rates are correlated to. Here, take a look at this chart. It's tracking the average 30-year mortgage rate alongside the Fed funds rate, which, by the way, is tightly linked to the 10-year Treasury yield. This year, as the 10-year slipped, mortgage rates slid right along with it. And falling mortgage rates, that's a good indicator that home prices are only going one direction, and that's up. Now, the 30-year bond yield also dipped after Jackson Hole, but here's the nuance. Long-term yields don't move as directly with Fed cuts because the Fed's real grip is on the short end of the curve. But once they fire up balance sheet expansion, the phase that follows rate cuts, they absolutely can lean on the long end if they choose to. Will they? Not guaranteed. Could they in a crisis? Absolutely. And honestly, at this point, nothing shocks me anymore. Anyway, I showed you the correlation of the Fed funds interest rates and mortgage interest rates. Now here's the correlation between auto loans in the green dotted line that you see here and the Fed funds rate that you see here in blue. So if the Fed cuts rates, then interest rates on auto loans follow. Now here are the interest rates on credit cards in the green dotted line you see there, and then the Fed funds rate is in blue. Of course, interest rates on credit cards are still going to be high, but they should drift lower as the Fed cuts rates too. And as the Federal Reserve lowers rates, this means interest rates on savings accounts and CDs are going to fall as well. So the more they cut, the lower the interest rates will go on these savings instruments. And you know, over the years, I've been a big proponent of Wealthfront. I've mentioned it here many times. It's an online savings account that really pays the highest interest rates that I've found. And I'll put a link to it below if you want to check it out. If you use that link, we both get an extra half point or something like that on our returns. But right now they're paying around 4 to 4.5% yield, which sounds great. But here's what happens when the Fed cuts. Every high yield savings account drops in lockstep. So if the Fed cuts by 0.75% by year end, like the markets are expecting, your Wealthfront rate could drop to 3.25 to 3.75. Still decent, but that's a real dollars and cents impact of these rate cuts on your savings. Again, by how much depends on how much the Federal Reserve cuts rates. Anyways, that's what happens to everything when the Fed does cut those rates. And of course, that's not all encompassing, but it covers the main points. But when it comes to real estate, I don't really see the prices coming down that much. Maybe in the short term, but not really. I mean, it sucks if you don't own any, and it should be comforting if you do, because real estate, it's a commodity too. And it should respond just like gold, silver, Bitcoin, and the S&P will in this environment. And here's the crazy part about real estate that most people miss. We're at the worst housing affordability since the 2005 bubble, according to Morningstar research. The only thing keeping buyers in the market? They're betting on refinancing at lower rates in a few years. The Fed has to deliver on rate cuts to prevent a housing market collapse. It's not just about helping the economy. It's about not breaking the housing market promises they've already made to millions of buyers. In my opinion, the prices, I think, are really at a low point. It's going to be regional, of course, and I could be wrong, but and I'll admit it if I am, but long term, I don't think you can go wrong with income producing real estate. And if you're finding yourself though, hey Matt, I'm just too busy for it, I get it. And if you'd still like some help with that, I made this video right here for you so you can do this even if you got a full-time job. All right, thanks for watching. Take care.